Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, May the 4th. Our note this week was titled, Say What You Mean. It's a reference to say what you mean and mean what you say. We took some issue with the dissents at the FOMC meeting to the alleged bias to ease, which is phrased as any additional adjustments. Additional adjustments does not, it's come to mean only in one direction, meaning rate cuts. The language was inserted into the directive when the Fed started the latest round of cuts back in September, but it didn't say cuts. It could be a cut or a hike based on the language. This is how the Fed gets themselves in trouble. And of course, the three dissenters, two were presumably, we're confident they were, the main advocates for ending quantitative tightening, the runoff of Treasury securities, and adding what they called reserve management purchases, which was additional balance sheet expansion in the front end of the curve out to 3-year securities to increase the amount of reserves in the system, which is an easing of policy. It's not just a technical matter. It created more reserves in the banking system that could theoretically, not even theoretically, could be lent because bank lending has in fact picked up. It's not really the reason, but it certainly could be a contributing factor. So it's an injection of liquidity. And those two wanted to change this bias to easing along with Neil Kashkari, who wants a series of rate hikes if oil prices remain high, which made our head explode because that's not what happened in the, in the early 70s, late 70s, 2008, when you had energy price spikes. They're disinflationary aggregate demand shocks. They're not reasons why the rate of inflation increases over time. They're relative changes in prices. So that was kind of goofy. So we suggested the Fed should say what they mean and mean what they say. Most of the note, though, was about sort of an extension on what we wrote a couple of weeks ago titled Renaissance. This was really looking at the impact of capital spending on growth and earnings growth in particular. There is unquestionably a very strong contribution from capital investment. Non-residential fixed investment averaged or added 140 basis points to GDP. Consumption only averaged 1.1% to GDP, and that is despite consumption being 4.5 times as large as non-residential fixed investment in absolute terms. Info processing equipment investment, capital equipment investment added 83 basis points to GDP. Software investment, 51 basis points to GDP. Compare that to personal consumption expenditures only averaging or adding 1.1%, with healthcare being almost half of that. So we really do have a capital spending driven economy right now. And that is good news for corporate earnings. It drives productivity growth over time. The chart I have in the background here is showing you industrial sector net revisions. This is not just AI. It cannot be, because this is a diffusion index that takes into account all increases in estimates less decreases in estimates. Yes, AI is permeating out through the economy, but we suspect that you're going to see capital spending really broaden out through the course of the year. It's why we like industrials, why we like materials, why we like energy. Financials will be second order beneficiaries of this. And of course, we still have a healthy exposure to tech and comm services, although on a relative to the index basis, we're a bit underweight just because they've become such huge parts of the index. But that's the theme we think you really should be leaning into. And for more details, become a full paid subscriber to Ironsides Macro. You'll get our asset allocation recommendations, our sector allocation recommendations. They're very specific by sectors, and you'll be able to really dig into all this, including our call on why Treasury yields are going up. Spoiler alert, it's being driven by the inflation component, which, based on our earlier comments, you could surmise we do not expect to persist. And we're a lot more comfortable with the back end of the Treasury market being driven by inflation expectations rather than there's been a little lift in the break-even curve rather than supply and real rates going up, which would tighten financial conditions and put the equity market at risk of a correction. Barry Net from Ironsides. Again, consider becoming a full paid subscriber. Have a good week, everyone. Thank you.